Okay, let's dive straight into this explainer. Today, we're going to investigate the hidden structural costs that are quietly draining startup profit margins, right in plain sight. Listen, if you're building a digital product, a SaaS platform, or running a global e-commerce brand, you are absolutely dealing with payment infrastructure. And honestly, chances are there is a silent leak in your unit economics that you're completely unaware of. So today, we're tearing down the whole facade of standard payment processing to see exactly where your hard-earned capital is actually going.
We've got 5 quick sections today. 1. The 2.9 illusion. 2. Extracting the raw data. 3. Unmasking the hidden surcharges. 4. The 5 margin leaks. And 5. The quarterly audit ritual.
All right, let's jump into section 1, the 2.9 illusion. Now, digital operators routinely bake a very specific assumption into their financial models right from day one. You know the one, 2.9% plus 30 cents. You've probably got this number memorized. It's that clean, flat headline rate advertised on literally almost every major payment gateway's homepage. It looks simple, it looks predictable, but founders frequently mistake this marketing headline for their actual cost of doing business. And let me tell you, in operational infrastructure, what is advertised is rarely what is executed. Because when you pull back the curtain, extract the raw, transaction-level data, and reverse engineer the actual math of these global platforms, a completely different number emerges. The true effective processing rate frequently climbs past the staggering figure of 4.02%. Just think about that. Just as a tiny 1% error in workforce capacity planning can entirely drain an enterprise budget over a fiscal year, this invisible fraction of a percent lost in your payment pipeline is silently, relentlessly eroding your net profitability.
So what's marketed is definitely not what's executed. And that gap between the promised 2.9% and the actual 4%, it's not a glitch or a mistake. It's a structural reality of how global payment networks distribute their unadvertised fees across thousands of your microtransactions. It's a massive gap that requires immediate auditing.
Moving right along to section 2, extracting the raw data.
Finding the truth requires us to visit the actual digital crime scene. And spoiler alert, you simply cannot perform an executive audit using those beautiful, colorful little charts on your payment processor's web dashboard. Those are for quick, high-level presentations, not rigorous optimization. They completely mask the granular variables where the real capital leakage occurs. Instead, you need to extract a minimum of 3 to 6 months of a very specific ledger file. It's called the balance CSV. This is a massive, heavy file that documents every single movement of funds, gross volume captures, rolling reserves, net payouts, and processing adjustments right down to the individual transaction level. Now, because these CSV files are just so massive and practically impossible to read manually, engineers often search for specific client-side tools to parse the raw data securely. To handle this right inside a web browser without exposing live system API keys to third-party servers or risking some massive data compliance breach, ops teams will literally Google Fee Auditor Stripe Balance CSV. Doing this surfaces dedicated tools designed to parse that raw ledger locally, so finance can finally isolate the true operational data.
Okay, section 3, unmasking the hidden surcharges.
So once we have that raw data in our hands, how do we actually identify the culprits behind the leak? Well, payment networks and acquiring banks aren't exactly known for labeling their extra charges clearly. Instead, ops teams have to actively filter the ledger for hidden penalties, masked as dense technical jargon and weird regional abbreviations. First, you've got to look for direct system markers like network assessment or interchange pass-through. Then, keep an eagle eye out for automated system penalties. These are cryptic billing codes like CHG fail 001, which is just a silent failed transaction retry, or changing line items like AC main change that mask your ongoing account maintenance fees. And finally, beware the deadly generic miscellaneous, other, or unmapped balance adjustments buckets. Processing networks love to dump complex operational costs in there, betting that your busy accounting team will never have the time to audit the underlying line items.
Which brings us to section 4, the 5 margin leaks. Once the data is parsed and those cryptic codes are unmasked, we uncover 5 distinct infrastructure traps that inevitably trigger the second a digital platform scales internationally. So where exactly does the money go? Look at the brutal math of the first trap. It's called the microbilling drag. This is an absolute silent killer for low-tier subscription plans. On a $5 monthly microtransaction, that simple 30-cent flat fee tax alone represents a massive 6% hit to your revenue.
Combined with the advertised 2.9% rate, your effective processing cost on that specific pricing tier instantly jumps past 9%. It just takes a huge bite out of your net revenue right out of the gate. Then we add in the remaining 4 leaks. First up, the cross-border penalty. The second an international card crosses your gateway, networks apply a quiet 1 to 1.5% surcharge that is entirely absent from their marketing pages. Second, hidden foreign exchange markups. Processors regularly bake a hidden 2 to 3% conversion markup directly into the exchange rate itself, completely hiding it from your standard accounting software. Third, non-refundable dispute fees. This one is crazy. Even if you use automated evidence-gathering tools and successfully win a chargeback dispute, networks still charge a permanent $15 to $20 penalty just for the bank opening the case. You literally lose capital for being proven innocent, no way around it. And finally, PCI compliance and underutilization penalties. This is where legacy enterprise processors trigger fees if you experience seasonal drops in transaction volume, just to compensate for their lost margin.
Now, you might be asking yourself, how do I know if we're bleeding capital here? Well, you can run the specific search query, fee auditor, what % does Stripe take? This helps you analyze and benchmark your own company's numbers against these deeply hidden industry leaks. It is absolutely vital to see exactly how your platform stacks up against these blind spots.
And finally, Section 5, the quarterly audit ritual.
So how do we pivot from just uncovering these staggering losses to actively recovering our capital? Checking your processing costs cannot be a one-and-done project. It has to become a programmatic, operational ritual. To regain absolute control, you first need to mathematically calculate your true effective processing rate. It's simple. Take the total sum of all fees, surcharges, and conversion loops over a given month and divide it by your total gross volume. To see how this math operates in real-world scenarios, a lot of teams map it out by searching for a specific Stripe fee calculator. This provides a clean framework for establishing your actual blended rate versus that theoretical baseline.
So here is your exact playbook. Execute these 3 steps. Step 1, calculate that effective processing rate we just discussed. Step 2, contact your payment processor's strategic accounts or merchant support team, informally request a complete fee disclosure report. You have to insist that they hand over the hidden interchange models your account is bound to. Gateways rarely generate these automatically unless you specifically demand transparency. And step 3, integrate a highly focused 15-minute audit into your company's quarterly operational checklist. Make it non-negotiable.
I love this quote right here. For a global SaaS business operating in a super competitive market, recovering even 0.5% of revenue from these silent infrastructure leaks doesn't just help cash flow. It flows directly onto the bottom line as pure, unencumbered net profit. It's capital you already earned. This reality brilliantly sums up why this 15-minute ritual matters so incredibly much for digital platforms operating at scale. Now, to streamline this entire operational workflow securely without writing a bunch of custom code or risking your API keys, modern software builders are relying on dedicated architecture found at feeauditor.com. It basically allows you to programmatically perform this vital audit and lock down your unit economics without the headache.
As we wrap up this explainer, I want to leave you with a final, provocative thought to investigate in your own ledgers. What is your true effective processing rate, and what is the illusion actually costing you? Don't just blindly accept the headline number. Get in there, dive into your raw data, uncover those leaks, and take back your net profit.